Hey guys, how's it going? Welcome back to the Module 3 of Technical Analysis Foundation, the complete professional trading course for beginners. Module 3 is all about market structures and patterns. In this tutorial, we will go through the sub-module 3.2, talk about how you can analyze the trendy markets like a pro, and review some of the biggest secrets of trend following. You guys ready? Let's get started. In the previous modules, we briefly touched on a little bit about uptrend and downtrend. Now, let's do a real quick recap. Here's how an uptrend looks like. There are four basic elements in an uptrending market: swing highs, swing lows, impulse moves, and the pullback moves. There are three key things we should be looking for in a healthy uptrend. First, the market has to make consistent higher swing highs and higher swing lows. Second, each trend leg has to make a similar or even stronger new impulse move going up. Third, there is no strong counter-trend momentum on the pullback moves. Here is a good example of a classic uptrend market, consistently making higher highs and higher lows, strong impulse moves, and minor pullback moves. In a downtrend, it's the same as the uptrend, but just reversed. We look for lower highs and lower lows. Each trend leg has to make similar or even stronger new impulse move going down. There's no strong counter-trend momentum on the pullback moves. And here's an example of a classic downtrend market. One thing you should notice that the volume and the volatility are much greater and higher when the price goes down compared with going up in an uptrend, which means the price tends to move faster and the rate of change increases in a downtrending market. We all heard the price never goes straight up. Studying about the pullbacks in a trendy market is important, but often ignored by beginner traders. Not only it gives traders great setups to enter the trend or add more positions during the pullbacks, but also the pullbacks can provide some valuable information about the trend we potentially continue or potentially finish. Alright, let's take a look at more details on the pullbacks. A pullback is a counter-trend move that leads to another strong trend leg in the direction of the original trend. When a pullback happens in a trend, it's usually to pause and consolidate the energy of the previous trend legs and prepare for another impulse move to make a newer high. One of the common causes of pullbacks are the potentially partial profit-taking activities in the market by other players in the market. Volume is typically lower in the pullback moves compared with the impulse moves. There are two types of pullbacks: simple pullbacks and complex pullbacks. There's a rule about the pullbacks called the rule of alternation. Basically, it means that it's extremely rare to find a trend that if the trend has 5 impulse moves and interrupted by the 4 pullbacks, it's really extremely rare to see if all those pullbacks are 4 simple pullbacks or all of them are complex pullbacks. Most common case would be 5 impulse moves interrupted by 2 simple pullbacks and 2 complex pullbacks. We talk about trend line in the module 2.3, now it's necessary to do a quick recap. Because drawing trend lines is crucial in analyzing trending market and understanding the underlying imbalance between buying and selling pressure in the market. In the uptrend market, we focus on the higher lows when we draw the trend line. By connecting each higher lows on the chart, we can get the uptrend line. This uptrend line is also considered as a demand line because the buying pressure is the strongest around this line. On the other hand, in the downtrend market, we focus on the lower highs when we draw the trend line. By connecting each lower highs on the chart, we can get a downtrend line. This downtrend line is also considered as the supply line because the selling pressure is the strongest around this line level. By using trend line, we can get many valuable visual information about the current trending market. So here are the 3 common information that we can achieve. First, the slope of the trend line can tell the traders how intense and how fast the trend is developing. Second, the length of each trend leg. It tells how strong and how sustainable the trend is. And of course, the trend line is one of the best places where you can identify the next potential pullback level. Alright, now I'm going to review the 4 biggest secrets in trend following. I call them the 4 trend following principles. These are the principles that the professional trend followers adopted in their system. So what are these 4 secrets? First, they buy strength and sell weakness. Second, they trade all markets. Third, they are patient with their winning trades and incredibly impatient with their losers. And last, They stop predicting the tops and the bottoms. Let me explain one by one and get into much more details to help you guys understand better. First, buy strength and sell weakness. It also means as a trend follower, you buy high and sell low. This is one of the biggest secrets in trend following that the new traders find is extremely challenging to accept because it's contradicting to our traditional buy low and sell high belief system. The first thing you need to do if you want to be a profitable trend follower is to stop thinking the price is too expensive or too cheap. In any market, whatever you think is too expensive, it can go much higher. Whatever you think is too cheap, it can go much lower. It's never too high to go long and never too low to go short. Legendary trader and hedge fund manager Paul Tudor Jones once famously said his favorite two indicators are 52-week new high and the 52-week new low. That's because as a trend follower, your trade decision should be measured by the strength or weakness of the market, not the price. The second secret principle is trend followers, they trade all markets. Being able to diversify your exposure to different uncorrelated markets is where trend following really stands out compared with other trading systems. Trend following does not focus on one single market. It looks at every market across all asset classes as long as it has enough momentum, like strength or weakness, and the liquidity, that means like how easy you can get in and get out of this certain market. Trend following is not about building a balanced portfolio. You have to remember that. It is all about picking and getting on the right trendy markets and get off when the trend starts to turn. The market spends more time staying in a range than trending. So increasing your exposure and expanding your watch list to more uncorrelated markets can greatly increase your odds of capturing a killer trend. It's kind of like a heat checking. Your goal as a heat checker is from the point A to point B as soon as possible before the day gets dark. You are standing at the crossroad of a highway and waiting for someone to get into the same direction and hopefully give you a ride. So the question is, do you actually choose what type of vehicles, cars you like? You might be a big fan of sports cars. Do you actually wait until a Ferrari comes and pick you up? Or you just jump in as soon as possible whenever someone offers you a ride, regardless what type of vehicle he's driving? I'm pretty sure the second person will get to the point B much earlier, and good luck with the Ferrari guy. The third secret principle of trend following is being patient with winners and being very impatient with losers. In trend following, people will tell you how much money they make a year, but there's one thing they will never tell you is that all the profits they generate each year come from a very few but big winning trades with a lot of small losses. This is how trend following makes you money. A few big winning trades with many small losing trades. So the biggest enemy of trend following is to take profit too early. If you want to be a trend follower, be prepared for three things. You will have to take many small losses before you catch a big trend. So learn to be comfortable with cutting losses quickly. Even though you finally catch a big trend, this winning trade might turn red for a moment, but your system doesn't signal to sell yet. Then you should listen to your system and don't sell. Learn to strictly follow your system and be patient with your winning trades. Always keep the 20-80 rule on your mind. 80% of your profits might just come from 20% of your trades. So do not miss those monster trends by taking too early profits. And the final secret principle of trend following is trend followers do not pick tops and bottoms. We all want to be right. It feels good whenever you predict a top or the bottom of the market that proves you're right. You feel like a superhero. It satisfies your ego. If ego is your top priority, then you should never be a trader. Because trend following is not about being right. It's about picking whatever is already right and follow it until it's not right anymore. So in fact, trend following is actually very, very boring. Trading in general should be boring. Analyzing market tops and bottoms is a valuable skill for every professional traders that everyone should have. But for trend followers, you do not get paid by picking tops and bottoms. Instead, you make money by taking advantage of the most juicy, profitable part of the market, the trend in between a top and a bottom. That's where you get paid. A good analogy for this is like eating a Big Mac. The most tasty, juicy part of a Big Mac is always the part that's in the middle. As a trend follower, that's gonna be where your profit come from. Alright, so these are the 4 secret principles of trend following. Once you understand all this, I'm going to share with you one trend following trade setup example. It's called a moving average bounce. There are two possible directions in this setup. Let's take a look at the long setup case first. This trade setup works the best in a clear uptrend, which means the 20-day moving average is above the 50-day moving average, and the 50-day moving average is above the 200-day moving average. And here, for the purpose of being simplicity, so I will take the 100-day moving average out of this example. This trade setup, I will only use three moving averages: 20-day moving average, 50-day moving average, and then the 200-day moving average. There's a special price action condition. The price has to test 20-day moving average or 50-day moving average twice and successfully bounce back and make higher highs. If that happens, then you enter your trade at the third time when the price tested the 20-day moving average and the 50-day moving average and bounce back with a confirmation candle bar. When to get out of the trade? When the price breaks the 50-day moving average and close below it for 2 days in a row, then you get off your full position. Your initial stop loss should be always 1.5 to 2 times of your average true range below your entry price. In all the trend following system, you should always use a trailing stop loss to maximize the profitability of this trend. One thing to notice is that this is a trade setup idea, not a complete trading system. Because other things like position sizing, trade management, and money management are also extremely crucial parts to a complete trading system. And then we're going to talk about that in the future Module 4 and the Module 5. Cool! Let's take a look at the short setup case, so the bearish case. It works the best in a clear downtrend market, which means the 20-day moving average is below the 50-day moving average, and the 50-day moving average is below the 200-day moving average. The price has to test 200-day moving average or 50-day moving average twice and successfully bounce below and continue going lower, making lower lows. If that happens, enter your position at the third time when the price tested the 20-day moving average or the 50-day moving average and bounce below with a confirmation candle bar. When the price breaks the 50-day moving average and close above it for 2 days in a row, and you should exit your full position. The initial stop loss should be 1.5 to 2 times average true range, but this time is above the entry price. Same thing, you should always use trailing stop loss to maximize the profitability of the trend. Alright, let's take a look at one example. The red line is the 20-day moving average, the blue line is the 50-day moving average. As you can see, the market is in a clear downtrend. The price tested the 20-day moving average twice, and then both were rejected and continue going lower. So that signals the potential short selling opportunity. As the market keeps going downtrend, the price just keep testing either 20-day moving average or 50-day moving average and fail to break it. This provides you with a great potential entry point that you can enter or even add more short positions that follows the trend. When the price finally breaks the 50-day moving average and close above it for 2 days in a row, you get out of your full position and take a pretty good return on this trade. So this is one of the simplified but classic examples on how you can use moving average bands, this setup, to ride a trend. If you want to be a successful trend follower like a pro, then there is one more thing you need to master, which is you need to learn how to tell when a trend is potentially exhausted or about to turn. In this course, I will give you 3 signs on the potential trend exhaustion. The first sign is called the weak push. It is a common pattern that suggests the trend is running out of the strength and the momentum. Weak push occurs when 2 upswing legs in a row are shorter than all the previous upswing legs. In other words, there are less and less buyers and buying powers in the market now. They are considered weak impulse moves and normally confirmed by a strong pullback move with higher volume and breaks below the previous swing low. When you see this sign happens in the market, you should be careful and watch closely, or even move up your stop loss. Weak push pattern doesn't necessarily signal the trend will reverse. Sometimes it can be the places where the trend stops and start consolidation for a period of time. Potential trend exhaustion signs number 2. Parabolic impulse. Whenever you see a series of extremely strong impulse moves on a chart, then there's a high probability that trend will reach exhaustion soon. This is one of the common ways to bring a sharp pullback to the trend because parabolic impulse can make a market more vulnerable to a sell-off. If you use an indicator called the Keltner channel, then you will know that it's extremely unusual to see candlestick bars that are completely outside of the channel for a long period of time. Whenever you see a few candlestick bars that are outside of the channel, then it's usually followed by a sharp pullback to the moving average. So here are the classic signs, or I would say the patterns, of parabolic impulse exhaustion. It always starts from accelerated trending rate, large range bars, many free bars outside of the channel, and then followed by a subsequent large pullback bar. So that's the typical pattern. If after the parabolic impulse, the trend will still continue its direction, then it's a positive sign that the buyers are still willing to commit and push the trend even further. And that's a good place for you to add some more positions. Potential trend exhaustion sign number 3. Make a lower high and a lower low. This is a very important pattern that you should remember because this is a potential trend reversal pattern. It is also known as a classic head and shoulder pattern. This happens when price pullback so strongly from the high that it breaks through the previous low and make a lower low. After that, when price tries to bounce back, but it's not able to take over the previous high, then it makes a lower high. This lower high is followed by another pullback goes even lower. When this happens, it usually signals the trend will start turning to another direction. So you should get ready to exit your trade or even start shorting this market, because this pattern strongly suggests the buyers are leaving and the sellers are taking over the market. The trend might start to reverse to a downtrend. Alright, so these are the 3 signs I would like to share with you guys on the potential trend exhaustion. Well, the first 2 signs could be the signs for temporary pullbacks and the consolidation, but the third sign can be a serious trend reversal signal, so please be aware of that. Alright, so I'm going to share with you guys some bonus tips on trend following. The length of each swing leg matters. Longer swings usually mean more conviction from the buyers on the trend direction. Don't forget to pay attention to the candlestick price action. The height of the candlestick bars matter, especially at the beginning and at the end of each swing leg. Large bars means more conviction. You want to see large bars at the beginning of a new impulse move and the smaller bars during the pullbacks. The best or the most bullish pullback that you want to see in the uptrend is a tight consolidation pattern, hovering at almost the same level with very small bars and a low volume. Also, do not forget about the higher time frame. Using a higher time frame can help you cut out a lot of noises in the market when you're using a lower time frame and confirm the trend directions even in a more clear way. Volume is always important. You want to see larger than usual volume at the beginning of the impulse moves and the low volume during the pullbacks. And the last one, it may not be for every beginner trader, but being able to analyze trends using Elliott wave theory is a very profitable skill to master. I will definitely make a crash course on how you can trade with Elliott waves in the future. Alright, before we wrap up, I would like to share with you guys one of my favorite legendary trader and a trend follower, Ed Sikota. He once famously said, "The trend is your friend except at the end when it bends." Trend following is all about finding the trades from whatever is already working until it's not. It's all about making the biggest profits from the most juicy parts between the market tops and the bottoms. Alright, this is the end of this tutorial on trend following. Hope you guys enjoying it and most importantly, learn something valuable. Again, thanks so much for watching and I will see you guys in the next tutorial. Bye for now.